Hi, and welcome to this week's Market Insights. A series of critical economic events is expected to drive market direction this week, including central bank decisions, as well as inflation, labour market and GDP data releases. So let's take a look a little bit closer at the key drivers of potential market volatility in the coming days. Now, first up, the Reserve Bank of Australia is widely expected to cut its official cash rate by 25 basis points to 3.6% at its policy meeting on the 12th of August at 7:30am GMT +3, with the market pricing showing an over 90% probability of this cut. Now, this would continue the RBA's shift towards monetary easing amid signs of a cooling economy. In June, the unemployment rate climbed to 4.3%, the highest in 4 years, suggesting growing slack in the labour market. Meanwhile, both headline and core inflation have eased, now sitting within or near the bank's 2 to 3% target range. Growth remains soft though. GDP rose just 0.2% in Q1, and annual growth is tracking at around 1.3%, well below trend. Household consumption is weak, pressured by falling real incomes and ongoing cost of living concerns. In July, the RBA held rates steady, surprising both the market and private sector analysts. However, this time a 25 basis point cut is widely anticipated, which could weaken the Australian dollar and support equities. Any unexpected decision, however, could trigger volatility across asset classes. Okay, also on the 12th of August, the US Bureau of Labour Statistics will provide the data on the inflation rate at 3:30pm GMT +3. Now, in June, US annual inflation rose for a second straight month, hitting 2.7%. The increase was driven by food, transportation services and used cars. Monthly CPI rose 0.3%, which was the biggest jump in 5 months. Core inflation rose slightly to 2.9%, although it came in below expectations. The monthly core CPI increased by just 0.2% compared to forecasts of 0.3%. Now, the pickup inflation was partly due to tariffs on imports, especially on furniture and recreational goods. Now, looking ahead, this week's CPI report will be critical as the Federal Reserve is expected to cut interest rates at its next meeting in September. Although that rate cut is already priced in, a rise in inflation may weaken the US dollar at least for a short term, just as it did after the release in July. Well, over in the UK, the unemployment rate on the 12th of August at 9am GMT +3 may trigger some volatility in sterling markets. The UK unemployment rate edged up to 4.7% in the 3 months to May 2025. That was reaching its highest level since mid-2021. Unemployment increased across all durations under 6 months, 6 to 12 months and over a year. Still, the number of employed people rose, led by both full-time and part-time jobs. There was also a rise in second jobs. Meanwhile, the economic inactivity rate declined. Now, the data has led markets to price in more dovish stance from the Bank of England and further weakness in the British pound. If the unemployment rate comes in higher than expected, the pound may well weaken after the release of the data. Now, sticking with the UK, on the 14th of August at 9am GMT +3, the Office for National Statistics will publish data on UK GDP growth. In May, UK GDP contracted by 0.1%, following a 0.3% drop in April, and missing forecasts of a slight rebound. Still, 3-month growth to May was up 0.5% thanks to modest gains in services, production and construction. After the release, the British pound weakened as falling growth increased the likelihood of a rate cut from the Bank of England. However, equities found support. The FTSE 100 rose 0.2% shortly after that data came out. Now, markets now expect stronger GDP numbers ahead, which could strengthen the pound, but pressure stocks in the short term. So we're going to be watching very closely to see how the GBP markets react when this data comes out. Now we're going to take a look at trade tensions, and there's no avoiding them at the moment. They remain a critical topic. First, high-level talks between the US and China continue ahead of the August the 12th deadline to extend the 90-day tariff truce. No formal extension has been confirmed yet. And without an agreement, tariffs could hit consumer goods, electronics and raw materials. Now, we know this whole tariff situation is changing on a daily basis, so do keep your eyes and your ears open. Markets are watching for signs of de-escalation, especially given recent volatility in FX and equities tied to US-Asia trade flows. Now, secondly, President Trump is preparing to announce a 100% tariff on all imported semiconductors. This would apply to all suppliers, including firms from Taiwan, South Korea and Europe. Now, that said, companies investing in US manufacturing like TSMC and Samsung may receive some limited exemptions. The policy aims to boost US chip production, but could lead to global price increases and retaliatory measures from affected nations. So be prepared for heightened volatility, review your risk management tools and stay updated with all the latest market news. And finally, we'll run through the earnings calendar. Looking at the week of August the 11th to the 15th, earnings season continues with key results from the mining, software and industrial sectors. So far, most companies have beaten expectations on earnings and revenue. However, any surprise misses could lead to sharp stock revaluations, especially in high expectation names. Well, that wraps up this week's Market Insights. There's an awful lot of drivers in play and price fluctuations are expected to stay elevated across key asset classes. Stay informed, don't forget your risk management techniques. Pop over to the news and analysis section on the FX Open website for some real-time updates. Thanks for watching, and as ever, we wish you luck with your trading in the week ahead. Bye for now.